It's kind of the ideal fit for somebody who is a high income earner, that their time is better spent actually doing their job, right? You know, like you guys talk about this too, like you got to have a way of making money. You got to have a way of investing money, right? Like if you're good at making money, like leverage the experts and let them be the stewards of the dollar, because this is what they do 80 hours a week, right? We all know this is not a 40-hour-a-week job as a real estate investor. It's not for me anyways.
Right.
Certainly not for the operators that I work with. So like going back to that initial point, do the due diligence, right? Bet on the jockey and trust but verify that they're going to be good stewards of your money.
You're listening to the AZREIA Show. If you're looking for quality real estate investing information that you can trust, you've found it. Stay tuned and join the tens of thousands of members that have already benefited from AZREIA, your home for education, market information, support, and networking opportunities that will advance your real estate investing career. You're listening to the AZREIA Show. If you're looking for quality real estate investing information that you can trust, you've found it. Stay tuned and join the tens of thousands of members that have already benefited from AZREIA, your home for education, market information, support, and networking opportunities that will advance your real estate investing career.
Hello, welcome to another episode of the AZREIA Show. I am your host, Marcus Maloney, and we have our co-host and executive director, Mike Del Prete.
Hello, hello.
Hey, and we're here as the AZREIA Show, and like AZREIA, we want to empower investors one property at a time. And today we have our very special guest, Randy Smith with Impact Equity LLC, and we're going to be talking about that transition going from corporate to entrepreneurship, and we're going to be talking about capital raising and syndication. So we got a little bit for everybody on today. So how are you doing today, Randy?
I am doing fantastic. Super excited to be here. Love AZREIA and anything to support you guys. So yeah, thanks for having me.
Thank you. So jumping in, how long were you a corporate guy?
Gosh, I was in corporate America for about 25 years. I spent the last 21 years across two different companies. So large portion was spent with two Fortune 100 or 200 companies there.
Okay.
Yeah.
Okay.
Yeah.
So you were on a traditional track, go and work 30 years, have your pension, well, you have your 401k
Yep.
and live the good life, get the gold watch, retire on the beach and everything like that, right?
That was the dream that they tell everybody. Yes, invest into the 401k, which I think is just a total sham. We don't have to get into that here. But yeah, you start looking at the clock and doing those calculations, and you figure out pretty quickly that the calculations in the 401k map tell you that you are not retiring anytime soon.
Yep.
So inevitably you'd be there till 65, 67 to have any type of retirement.
What's the it's like over the lifetime of a 401k, it's like 70% go towards fees. Do you ever hear that stat or something close to that?
Yeah, I don't know what the exact number is, but if you factor in 1+%, it dilutes those returns pretty significantly. And if you see, there's some very specific calculations that show average returns in the 7% range, but that doesn't factor in the 1.5%. It actually brings it up below like 4%. If you look at average 401k returns over any amount of time. And
there you go.
Yeah, so you can always get a better return managing your own money as long as you have wisdom to do
education.
So. Yeah, and education. And that's what we provide here. So tell me, Randy, when that light switch finally went off, what did you think? What was your next step? Was it, oh crap, you know what, I'm not going to retire until I'm 70 something.
Yeah.
You know, what did you say? What was the next thing you had to do?
Yeah, so mine was kind of unique. I mentioned I was with two companies for about 10 years each, and I ended up getting laid off of that first 10-year career. And I had a little bit of 401k, still had some bills like we all do, credit card debt, house debt, all of that other stuff. And I did get a severance, thank goodness, because I'd been there for so long. But every day that severance ticked by, it got scarier and scarier, because if I didn't have a job before the severance was gone, I didn't know what we're going to do, right? So fortunately, I landed at a great organization, and actually ended up making more money in that next role than I ever imagined I would make. But about halfway through that second 10-year, it kind of dawned on me, like, I'm heading down the same path. And while it looks really good, I need to do something different. Otherwise, with
Right.
some foreshadowing, ultimately, I ended up getting laid off after 10 years yet again.
Oh, wow.
I think, I started going to AZREIA probably 6-7 years ago.
Okay.
And it was under different leadership and kind of a different environment. It was down at
Celebrity theater.
Celebrity Theater. Yeah, very different than what you guys are doing today. And that really helped me jump into real estate investing one house at a time. So,
Okay.
yeah.
All right. So what was that foray? What was your foray into real estate? Was it a rental? Was it a fix and flip? Kind of,
Yeah.
what was that first thing?
Yeah. So my very first real estate investment after my primary residence was a turnkey rental in Kansas City.
Okay.
And I heard an turnkey operator on a podcast that I'd listened to for years. And I've been sitting on the sidelines for years and finally went home all excited, told the wife, we're doing it. We're buying these and we're buying houses in Kansas City, honey. And
What was her response?
she was not as excited about it as I was, I will say, but I wore her down and we ended up buying those first couple of properties there. So
Okay.
That's a good point, though, for especially you guys have your 9-to-5s, you're working, everything's stable and moving forward. And we always mention that in the Launchpad session where it's just like we're doing our business planning for real estate investors. And it's like, you got it. Even if your wife's not, or husband, spouse, whatever it is, not in the class with you or not actually doing the daily activities, they should understand what you're doing.
absolutely.
Because if your spouse isn't supporting you in this business, it's not going to work.
It's interesting you say that too, because I, like everybody, or maybe not everybody, but a lot of folks, I read The Rich Dad Poor Dad. And I was a sales guy. So I was driving around listening to books and podcasts. And that was when I listened to that really got me excited. And I actually had my wife listen to it. And
Good.
she was gracious enough to say, I'm not really interested in this, but I'll take 4 or 5 hours and listen to the book or read it, whatever
There
it
you go.
is.
That's it.
And that kind of planted the seed in her as well, that maybe this could be a way. My catchphrase is decreasing our dependence on our W-2 income.
Yep.
And as luck would have it, that worked. So
Okay. So the turnkey model, and I can understand why, because it was like completely hands off.
Yeah.
Just pay the money and they collect everything and then you get a distribution check really every month.
Sure.
So that was working excellent, right?
in theory, that sounds fantastic. Like even today, that sounds
Were
so
you investing,
appealing
Marcus?
to me. Yeah, it's amazing. You just cut a check for the down payment and next thing the mailbox money
Yeah.
starts.
Passive income.
Not my
Right.
experience at all.
Okay.
Yeah, it was anything but passive. Gosh, we're buying $100,000 houses in Kansas City that are getting $1,200 a month rent, which 1% rule,
Yep,
it's going to
it
work,
pencils,
right?
right.
Yeah. Well, I made a lot of mistakes. I didn't do the due diligence I should have done. I threw too much money at it too fast.
Okay.
And we had a roof replacement at like month 1. We had like a $4,000 like plumbing issue where they had to excavate the outside of the house, and we had they have basements in Kansas City.
Yep.
I didn't know.
What's
I
a
didn't even know what that was.
Especially
Right?
in Arizona.
Yeah.
It's like
And it was like month after month, $5,000-$8,000 bills come in for this plumbing issue, and it was a nightmare.
let's
I
just
mean,
touch on
absolute
that
nightmare.
really quick because and you said turnkey.
Right. Right.
Yeah.
I'm like, what's going on here? So
Yeah.
so not every turnkey operator is equal. So you have we always say you must do your due diligence on even the turnkey provider. Sounds great. I just invest into the project. It's already remodeled, but you don't know what's behind that sheetrock or that new cabinets they put up. You don't know if they did the plumbing like you said.
Right.
Right. So inspection period or your home inspections even on a turnkey.
Absolutely. And you need to do that, especially when you're going into those cold weather climates, when you're north of the Mason-Dixon line. Is that north of the Mason-Dixon line?
It's like,
Yeah,
sure.
yeah, I think it
sounds
is
good.
north.
Yeah.
No one's
So-
gonna check Marcus.
Yeah, exactly.
I don't even know what that is.
It's going to be Instagram comments. I can see them now.
Let me
right?
Google it.
Yeah. So it's up there. It gets cold below
snows
zero.
there, yes.
Right.
Yeah,
So
definitely snows.
yeah, and you have expanding and contracting soil. You have to deal with cracks in the foundation, stuff like that. So, and that's where a lot of, and I don't want to say turnkey operators are doing this intentionally, but they know people from California, Florida, Arizona, they're looking for a return on their money. And the Midwest is normally a solid hedge for recession, inflation, everything like that. So they get a lot of money from West Coast, East Coast, Southern areas to go into these areas. So not to say that it was just you, Randy.
No, I'm
You
sure.
know-
I'm sure it wasn't. Sure it wasn't. Yeah.
You know, out of state investing is great and it's definitely possible. But just be careful. Not all states are created equal. Just because it's a red state, that doesn't mean it's totally landlord friendly like Arizona. You know?
Yeah.
Well, and I will say there were a number of lessons in that process. So through the onboarding process or buying that, he offered the ability for me to have an inspection on it. And he said, now we've done our own inspection, but if you want to spend the $300 to $500 yourself, by all means. And, you know, in my mind, I'm like, hey, he seems like a trustworthy guy. I'll take a look at his inspection
right.
and trust that. And we would have clearly found the issues in the plumbing issues. Definitely. We definitely would have found the issues with the roof had we spent the $300 to $500. So the lesson is definitely hire your own third party folks to take a look at these assets. And generally they'll give you a checklist of here's the 8 or 10 things that you need to get resolved before you buy it. And I could have avoided all of that. So
Love it. So thank you for sharing that $10,000-$12,000 mistake with us.
You're welcome. You're welcome.
Appreciate it.
Yep.
Yeah.
Well,
no, but it's so important.
It absolutely is.
Sometimes you got to learn that way in order not to do it again.
I will always get an inspection on every deal I ever buy moving forward. So, and it's in hindsight though, like even though all of those issues happened and I poured a ton of money into those assets, real estate's so forgiving. After I sold those in 2022, we ended up making a bunch of money on them anyway. So while the cash flow wasn't there, the appreciation was such that we did very well on those investments. So,
you got lucky.
I did. We had a market that was working in our favor.
Well,
definitely.
Let's also talk about the part for the people listening that are in their job and they're trying to do that move that you just did. So that got to be stressful on your family. Like, hey, honey, you just got me in. I read the book. The book didn't say this part.
Yeah.
so how'd that work? How'd you just, I don't know, just how'd that work out?
Yeah, no, definitely. And there was a constant, I won't say struggle, but there was certainly friction when real estate came up. When I joke with my investors today, like, I don't want to be a bad name in anybody's household, right?
Yeah,
and,
for sure.
And this person I bought from was a bad name in my household. Whenever his name came up, it was bad. So we certainly had some tense conversations when we invested $50,000 in 2 assets, 25% down. And when that $8,000 bill shows up, the look on the wife, it was tense. When like that's not coming out of, not many people just have 8 or 10 grand just sitting around, right?
Yeah.
So we had to get creative and we had to tighten the belt and do all the things you do, you know, to play in the space.
So what was your steps in vetting that operator?
So, and ultimately that's the biggest issue is that the due diligence process was not there. I made the mistake of assuming that since this guy was on a podcast, of a podcast that I'd listened to for years, I assumed that they would not put somebody on there that they hadn't vetted. Even though every episode they say, we do not put our stamp on any of these folks, please do your own due diligence, right? But I assumed by affiliation that these guys were solid. The next big error was not getting my own piece. And I never flew out to the properties either. I like to see assets that I buy today. I don't think you have to do that, but just out of my experience, I like to put my eyes on them and walk around. I'm going to go walk a property as soon as we're done here. Those were the 2 big things. I think one other thing that was kind of interesting is you hear everybody say like, ask for referrals. Well, I asked for referrals, but if you ask anybody for referrals, what type of referrals do you think they're going to openly give you?
The best ones.
Of course. My buddy Johnny, who's invested with me for 20 years, maybe he has, maybe he hasn't, but he will say that, right? So I talked to some prior investors, but I don't know. Like it's better to get a third party or get a referral from a referral on that type of due diligence process. And that's what I do today. I don't invest with anybody unless I know somebody that has and has had a very good experience with them.
Excellent.
So that was the first property. So let's keep moving forward. So what else? You bought a few more properties?
We bought 2 back to back in Kansas City. And then all the issues started happening. And I like the idea of long-term rentals, get rich over time, not get rich overnight. So I wanted to have more control in that renovation process. So we started doing the BRRRR strategy. And we actually ended up following some direction by a guy named Neil Bawa on how to select markets. And we ended up buying in Atlanta. And we bought within the perimeter of Atlanta. So it's, you know, these are Class C neighborhoods, maybe even Class C minus neighborhoods. And we ended up buying a handful of properties within the perimeter. renovating them way over the quality of where we should have renovated them
Okay.
because we watched way too much HTV, right? But we did really well on those, and that was a fun experience. I think we ended up we bought what, 3 or 4 more in Atlanta. We had one that we bought where, again, I didn't take the same direction I'm giving people, but we bought an asset that the guy said, get a foundation guy out there. We trusted our realtor. He said we didn't need one. We needed a foundation guy. It ended up being a teardown.
Oh, wow.
We sold it to somebody who wanted to do a teardown, but all in all, we ended up, I think we had 5 or 6 at one point, and we did some full gut rehabs. We did the true BRRRR strategy, buy, renovate, refinance, or rent, refinance, repeat. And I loved that model. We made a lot of capital doing that model, but then the market just exploded and we couldn't find any more houses.
No more deals.
And I wanted to go bigger, faster, because that's just the type of guy I am, right? So we started looking at multifamily.
Okay. So you speak of Neil Bauer, great guy when it comes to statistics and everything like that, and demographics on certain regions. And he really hones in on that Southeast area. So, okay. Get it. So guys, I think everything Randy is saying is do your homework, right?
Yeah.
Do your
Trust,
homework,
but verify the operator, verify the property, verify your realtor, verify your contractor, everything like that. So don't be afraid of out-of-state investing. What Randy is saying is you just got to make sure don't just glance over some of the things that you may think are small things.
Yep, absolutely.
Awesome, man. So then one day, tell us how you got laid off. How was that?
I got laid off.
Was it like a office thing? Was it a letter, or was it like?
Yeah. So the layoff day, we heard the rumblings. We knew something was coming. I thought I was going to be safe. I had been a top performer.
Yeah, 10
I
years.
just won a President's Club award, and
So your sales were on point.
sales were on point.
Yeah.
We were crushing it. I was training people. Anyway, so I thought I was going to make it through. And the rumblings start that morning. You hear phone calls are happening on the East Coast. We're here in Phoenix, right? So
you got
people are getting
delayed.
late, and you're just like waiting for the phone to ring. And sure enough, I got the invite from the vice president saying, "Hey, we need to chat." And it was actually about 2.5 hours before the call. And I actually took that opportunity. I'm not tooting my own horn, but I kind of got my things in order to pass things off to my teammates because I wanted to leave on good grounds. All my active opportunities, because I was a sales guy, I'm like, there's some hot deals here. Go after these guys. And the phone call occurred, and it's Randy, unfortunately, we got to let you go. And like, it was all of a 2-minute conversation.
Yeah.
Once again, there's a severance coming because I'd been there 10 years, almost 11 years. And fortunately, though, through my decisions in real estate, like a very large portion of our monthly expenses were covered by passive income. So while my peers were freaking out and like, people were like hysterical. Like, what do you, like, some people have been there 20 years freaking out. What are we going to do? People are very, very angry. But like, how could you possibly?
You had a very eloquent answer. Like, you prepared for your next person, but everyone else. I was asking if you did that in the movie, the Dave Chappelle movie with the cheeseburgers.
I don't know that one.
He starts flipping everybody off, and he's like,
Yeah.
F you. He kicks down the TV. None of that.
None of that. No, I
gotta go.
honestly, to this day, like those 10 years I spent at that company were amazing.
Yeah.
Right. Like
Good. I love
it gave us the financial foundation to be able to invest in real estate. I loved almost every single
set you
moment I
up.
spent in that.
Yeah.
They did.
Yeah.
Like, we're set for life,
Yeah.
essentially.
Right.
Right. And I'm super grateful for the time that I spent there, and grateful that, we had the intuition to think that we needed to do something else as well. So I think like real estate is like, it gave up my family the financial freedom that very few people that I know have. So
what I'm hearing and what's good is, even though you had those mistakes and those setbacks and everything like that with the Kansas City properties and the Georgia properties, it still left you in a good position when you got that phone call to let you go. So
Absolutely.
like you said, real estate is very, very forgiving, but you have to jump in and get started. And because you did that, Randy, you hedged yourself right now into what you're doing.
absolutely.
You have the more streams of income you have coming into your life, the more financially healthy you are.
Yeah.
Absolutely.
So, and that worked out. So,
When I would say there's one other element we didn't talk about here today is my wife and I were like due diligence or huge Dave Ramsey fans.
good.
Okay.
So we lived
Yeah, I love that.
very, very frugally. We are crazy. Like we paid everything off, right?
Okay.
Like we were getting, we knew that it couldn't go on as good as it was going on forever.
Right.
So like to this day, we still live, we like nice things, but we live frugally and we live within our means, which seems to be the rare occasion.
Right.
But it's something that I try to teach my daughter and those around me as well. Like I think real estate is a great way to get wealthy over time, but you still have to be smart with your money. Right? And if you're coming into anything desperate to make money, that's not going to work out well. I don't think.
And you teed me up because I'm glad you said Dave Ramsey, because in real estate, especially online, people make fun of Dave Ramsey. Oh, he's stupid, whatever it is. So my theory on that is he's brilliant. Obviously, he's proved it, and it's marketing 101. He's talking to a demographic of people.
Yep.
Right? He's not talking to everybody. He's not talking to real estate investors, flipping multifamily. He's talking to people that have a money problem or financial education.
Exactly.
I see those people come into the REIA, skipping that Dave Ramsey level. And would you want that person raising millions of dollars or hundreds of thousands of dollars and going and buying properties out of state and not know how to budget a checkbook? You know what I'm saying? So if wherever you're at, I think I heard this before, was Susie Orman, right?
Yep.
If you know nothing, you just got terrible habits, listen to Susie Orman, right? She'll yell at you, don't buy that candy.
Right.
And then if you want to get the next step up would be Dave Ramsey, where you're getting your stuff in order, you're paying off your debt, everything's free and clear, you got a control over your money and a sound mindset. And if you want to get rich, listen to Robert Kiyosaki.
Join AZREIA.
Join AZREIA. There you go. I like that. You get what I'm saying? So there's levels to it, right? So Dave Ramsey's good. So if you don't know how the basics of financial literacy, come to our FIRE group here with Tracy Royce, or go to Dave Ramsey, wherever it is, to get that basic foundation. So thank you for sharing that.
Yeah.
Yep. So we said all of that to get to this, right? So you got laid off. You're already dabbling in real estate, got a firm foundation. And then you say, you know what? I want to go bigger and I want to go faster. And you decided to take the jump into multifamily. Yeah. Tell us about that experience, because you don't go from single family to multifamily without having some sort of liquidity in order to buy these assets, right? So how did you do that?
Yeah, so my path was a little bit different than some folks in that I was doing BRRRR strategy, which was working, but then the markets shifted and I couldn't find any more houses where that would work. So I started looking at buying potentially a 10 unit, 15 unit, something like that in Atlanta. We looked at some in Atlanta, we looked at some in Arkansas, and we're looking at $1.5 million deals. So you start looking about the amount that you've got to bring to those type of deals. Very different type of investment. I hadn't been introduced to the syndication model yet, but I started hearing about that. And syndication, essentially, it's just bringing resources together, usually people. You might have a capital guy, and then you've got an acquisitions guy, and then you got a property manager, asset management guy. But when I was looking at those assets, I was just planning on doing that all alone. And I got spooked and decided I had no business managing these single families, quite frankly, right? Certainly I had no business buying $1 million assets. And I started to hear more about the syndication model and that you could actually passively invest. So my thought was, I'm going to take some money from an old 401k from when I worked at the previous 10-year job, and I could place that money as a passive investment in a syndication. The first one was actually a mobile home park, right?
Love it.
I later would do multifamily, but I thought that would give me the way to kind of peek behind the curtains on how the syndication model works to see if it's something I wanted to do in the future, right?
Okay.
So I placed a couple of those. I started getting distributions, and I'm like, man, this is true passive income. Like this is the mailbox money I've been hearing about forever. Like when I bought Turnkey, I thought it was going to be like this. You just start getting checks. So I kind of went all in on that. And I invested, I think by the time I got laid off, I had been in 12 or 15 deals. And the checks would just show up at the beginning of the month. They'd hit the bank account. It was like a cash register. And I had just decided, like, I'm going to keep doing this because the general theory is, like, we can double money every 3 to 5 years.
Right.
So if you get X amount of dollars in there doubling every 3 to 5 and you're getting cash flow, like I can just bow out in about 5 years or so, or get laid off and then change directions entirely. But that was kind of my intro to it. And being a sales guy, I'm telling everybody, right? Like,
Right.
dude, I invest
Very
25
important.
grand. I'm getting hundreds of dollars a month. It's like owning a house, but I don't have to do anything,
Right.
right? And so they get excited about it. And I start referring them to the people that I'm investing with. And by the time I laid off, I'd probably referred $1 million to this other operator. And when I went and talked to my network after getting laid off, he says, why don't you raise capital for me? Right? Or other people.
Right.
Like, clearly you're a sales guy. You've got a network of high net worth folks or high income folks. Maybe it'll work. So I launched Impact Equity with the goal of providing diversification to the passive investor. And we have multiple operators, multiple markets, multiple asset classes. You can get true diversification investing with Impact Equity. And the first deal was a wild success. So it just grew from there.
So now, you're raising money and you're bringing the pool of money to a fund that already has a project, right?
Yep.
So one thing I'm thinking about, the person that might be listening, where they might want to go and ask someone to borrow money, friend, family, coworker, whatever it is.
Yep.
They may feel like, how do they protect? They don't want to lose that person's money. They want to protect. They think like that person wants to own the house. Like, how are your clients? Do they ask you like, well, am I going to own this building? Because they're really not, are they? Or how's that work? for you?
Yeah, it's interesting. So it's technically you're owning a very small piece of that investment as a passive investor, and you get all of the real estate, all of the tax benefits of being involved in that deal. You get passive losses, you get tax write-offs, all of those things, right?
Great.
Now, you might only own 0.4% of that 500 unit apartment complex, but you're technically an owner of real estate, right? And I think it's kind of the ideal fit for somebody who is a high income earner, that their time is better spent actually doing their job, right? You know, like you guys talk about this too, like you got to have a way of making money. You got to have a way of investing money, right? Like if you're good at making money, like leverage the experts and let them be the stewards of the dollar, because this is what they do 80 hours a week, right? We all know this is not a 40-hour a week job as a real estate investor. It's not for me anyways.
Right.
Certainly not for the operators that I work with. So like going back to that initial point, do the due diligence, right? Bet on the jockey and trust but verify that they're going to be good stewards of your money. So I don't know if I answered the question. I get excited about it because it works.
We'll take it.
Yeah. Okay.
No, you did, man. That's awesome, man. So, yeah.
So it's similar to what we were talking about, right? The fund to fund model, right?
Yep.
So you raise the capital. You're not out looking for an asset or anything like that. You already know that these other operators got the assets. You say, hey, you know what? I raised $1.5 million. We're looking at an asset to deploy this capital into, and then you just set it with them.
That's it. Exactly.
You blew my mind. Like all these years in the business, that's why I still learn on every deal and every investor I meet. I always learn something as long as you're in the game, because you're, right? Because that's how I look at it. People are like, hey, Mike, I want to do a deal with you. But I'm like, shoot, I got to go find a project. I got to run the project. I got to get my team together and run AZREIA. So it's always like a battle, right?
Yeah.
So I don't want to take anyone's money if I can't put my full attention. So, but then when you came and filled in for Jose at the multifamily subgroup, man, you're wholesaling money.
Yeah.
That's it.
You know what I mean? You're going out, everyone trusts you. They're going to lend you the money. You take your fund of money and you go to a established, larger fund that you believe in and has a great track record.
That's it.
And everyone wins.
That's it.
And you don't have to run the day-to-day operations. I was like, man, that's brilliant.
Well, it's my, sounds kind of weird, but my superpower is connecting investors with great opportunities. Like some people are superpowers at finding great deals. Like I'm not good at finding good deals, right? I spent far too many hours in hell over my sales career. I don't want to do
You don't want to hunt
I don't wanna
anymore,
do that, right? And some people are just really good at managing assets. They love fixing toilets or teaching folks how to fix toilets and all that other stuff. Like I'm a connector. That's what I've always done. And I always tell my people, like, figure out what your superpower is and then go deep, right? If whatever it is, go deep on it.
Yeah.
And you're going to be better off investing in your strengths than you would be trying to fix your weaknesses. Like my weaknesses that I had 30 years ago, they're still my weaknesses, no matter how much I work on them. So,
like our mutual friend, Justin, we were talking about, like, we had lunch. He's an underwriter.
He's an
Right,
underwriter,
he pulled out his spreadsheet on his cell phone. I'm like squinting my eyes. He's like breaking it down all these rows and all these Excel files. I'm just like, That's why you do what you do.
Yep.
I don't do
That's
that.
it, exactly. You're my underwriter.
Yeah.
This guy over here loves operations. By all means, man,
That's amazing.
do it. Right.
So how did you go about finding and trusting and verifying those in operators?
Yeah, so it's been an evolution, no doubt. At first, it very much was, I started investing, well, I mentioned earlier, I worked for Fortune 100 or Fortune 200 companies. So I like big organizations. I like big brands. I like they have the ability to put resources on, like something goes wrong, they can throw resources at it, right? So I looked for very large operators that had fully integrated operations, meaning they do their own operations, they do their own property management. And since I focus primarily in the value add space in multifamily, I wanted to see them having control over the construction process. Because this is basically a big construction deal is what it is, right? So you've got to, the more they can control of that, the better, right? So I form my due diligence today on, first and foremost, what have they done in the past? And is it what they're suggesting they're going to do moving forward? I don't like operators that maybe they've done Class B value add and all of a sudden they're going to do Class C stabilized or Class A, whatever. Like I want cookie cutter, simple, rinse and repeat over and over and over again. So looking at what they've done in the past, but then like truly looking at their operations and seeing that they've got the resources to do what they say they're going to do. If you're saying that you're going to renovate 200 units over the next 2 years and you're hiring subcontractors to do it, I'm a little concerned about that, right? So
too many variables.
Yep. I've started doing background checks since I've admitted I'm not an underwriter. I've hired third-party underwriters to really do the due diligence on those. I talk to people. Generally, I don't invest or partner with folks unless I've been referred to them by people I know, like, and trust.
Okay.
Yeah, kind of the list goes on and on.
Gotcha.
We've got like a 22-point checklist we go through to vet these deals now. Yeah.
Cool, man. Well, our time is running up, Randy.
Yeah. So lastly, what's next? What are you working on and how can we get a hold of you?
Yeah. So easiest way to get a hold of me is on my website, impactequity.net. We just had a rebrand last week. It's beautiful.
Awesome.
I'm super excited about that. I do have a podcast called The Gentle Art of Crushing It,
Cool.
where we focus solely on educating and inspiring the new or newer passive investor. And what's in the future of Impact Equity? I've got 3 partners that I work with today, and I have 2 new partners that I'm going to be onboarding in the near future. We're going to get
Thanks for
into
listening to the
something
AZREIA
called
Show with
infill
your hosts,
development,
Marcus Maloney
where we
and Mike
find
Del
a small
Prete.
piece of land and
We hope you
townhouses
enjoyed this
and
episode.
condos.
If you found
And
this
then
information
I'm actually getting
valuable,
into the debt
head over
fund
to
space
AZREIA.org
as well,
and learn
which is
more
a
about our
really good
community.
option for folks that want to have liquidity with their investments and earn better than what they can earn with high yield savings accounts. So somewhere around the 10% range with 30 to 90 day liquidity. So that's kind of what I'm working on right now, but we'll continue to do Class B value add because that's
Bread
what
and
got
butter.
us here. And that I think is what's going to be the foundation moving forward.
Okay.
Awesome. All right.
Well, excellent. You guys know exactly what to do. Reach out to Randy at impactequity.net. Check him out. If you have some money that you want to place, vet Randy, do your due diligence, and maybe it may be some investment opportunities there for you. And he's a local guy, so you can come in, you can meet him at AZREIA at the monthly meeting. He help out Jose, filled in for Jose for the multifamily subgroup. So he's a friend and family of AZREIA. So come and check him out. So guys, thank you so much for another quality episode of the AZREIA Show. You know what to do. Feel free to go and give us a 5-star review. Let us know exactly how we're doing. And if you have any guest recommendations, feel free to let us know also. So thank you so much. And remember, we're empowering investors one property at a time.
Thanks for listening to the AZREIA Show with your hosts, Marcus Maloney and Mike Del Prete. We hope you enjoyed this episode. If you found this information valuable, head over to AZREIA.org and learn more about our community.